I need to share something with you about September 16th, 1992, something that most people don't understand, something that revealed not just the limits of government power, but the very nature of how markets interact with reality itself. I'm George Soros. You may know me as the man who broke the Bank of England in 1992, making over $1 billion in a single day. You may know me as a hedge fund manager who generated returns of over 30% annually for 3 decades. Or perhaps you know me as a philanthropist who has given away over $32 billion to support open societies around the world. But what I really am is a philosopher who happens to understand financial markets. And what I understand, what I've built my career on understanding, is that markets are always wrong. Not sometimes, always. The only question is, by how much? Before we continue, I encourage you to subscribe to this channel. The ideas we discuss here challenge conventional wisdom and are based on decades of experience in understanding how markets really work. What happened with the British pound in 1992 is a perfect example of what I call reflexivity, a concept that will help you understand not just this crisis, but every financial crisis. Most economists believe that markets move toward equilibrium, that prices reflect fundamental reality. They're wrong. Markets don't just reflect reality, they help create it. The participants' perceptions influence the fundamentals, which in turn influence perceptions, creating a self-reinforcing feedback loop. And on Black Wednesday, as it came to be known, we saw this process play out with devastating clarity. The British government spent $22 billion in foreign reserves trying to defend the pound. They raised interest rates from 10% to 15% in a single day. They deployed every tool at their disposal, and they failed. The final cost to the UK Treasury, £3.3 billion. My quantum funds profit, over £1 billion. But this wasn't just a trade. It was a demonstration of a fundamental truth about how the world works, a truth that threatens not just financial stability, but the very fabric of democratic society when governments pursue policies built on misconceptions. By the end of this video, you'll understand the philosophical framework that has guided my investment decisions for over 60 years, and what you need to do to protect yourself when similar situations arise. Let me start with a proposition that most economists reject. Markets are always wrong. They don't reflect reality, they help create it. On October 8, 1990, Britain joined the European exchange rate mechanism, pegging the pound to the Deutschmark at 2.95 decimeters. The idea was simple. By tying sterling to Germany's strong currency, Britain would import German monetary discipline and finally control its inflation problem. But let me show you what was actually happening beneath the surface. UK inflation in 1990, 9.5%. German inflation in 1990, approximately 3%. UK unemployment in 1990. 7.1% UK interest rates required to maintain the peg, 10-14 by September 1992. The situation had deteriorated. UK inflation, 3.7% falling, but at tremendous cost. UK unemployment, 9.9%. UK GDP growth 1992-1992, minus 0.2% recession. German interest rates, 9.9%, highest in 60 years, driven by reunification. Conventional theory says these were just painful adjustments toward a new equilibrium. The currency peg would hold, inflation would fall, and eventually prosperity would return. But what I saw was reflexivity at work. Let me explain. There are 2 functions in financial markets. The cognitive function, where participants try to understand reality, and the participating function, where their actions change that reality. When these interact, they create feedback loops that take markets very far from equilibrium. In the case of the British pound, here's how the reflexive process worked. Britain entered the ERM at 2.95 decimeters per pound, a rate that was already overvalued given UK's productivity and inflation levels. To maintain this overvalued rate, the Bank of England had to keep interest rates punishingly high, even as the economy sank into recession. High interest rates depressed economic activity. Businesses failed, unemployment rose, housing prices collapsed. The economy weakened further, making the currency peg even more unsustainable. But the government's commitment to defend the peg at all costs became a matter of political prestige. This created a fatal misconception that political will alone could overcome economic fundamentals. Prime Minister John Major and Chancellor Norman Lamont stake their reputations on staying in the ERM come what may. Their commitment was supposed to reassure markets. Instead, it created an opportunity. Understanding fallibility is crucial here. The British government was operating with imperfect understanding. They saw the ERM as a solution to inflation. They didn't see it was destroying their economy. They believed their $24 billion in reserves could defend the currency. They were wrong. And these misconceptions weren't passive. They actively shaped reality. The more the government committed to defending an indefensible peg, the more certainty traders like myself gained that the peg would break. The government's confidence actually increased our conviction. Let me show you how far perceptions had diverged from fundamentals. By September 1992, Britain needed interest rates of perhaps 5-6 to support economic recovery. Instead, they maintained 10% to defend the peg and would raise them to 15% on Black Wednesday itself. This 500,900 basis point differential represented the cost of the misconception. Germany, dealing with reunification inflation, needed high rates for its domestic situation. The UK, in deep recession with falling inflation, needed exactly the opposite policy. But the ERM forced Britain to shadow German monetary policy despite completely divergent economic conditions. UK manufacturing was 25% less productive than Germany's. British exports were uncompetitive at 2.95 decimeters. Every month that passed, the structural imbalance worsened. The market could see this. I could see this. Eventually, reality would assert itself. This is not a free market correcting itself. This is a self-reinforcing boom that will inevitably become a self-reinforcing bust. The trend maintaining an overvalued currency through political will was built on a misconception that commitment could overcome economic reality. And when trends are built on misconceptions, they eventually collide with hard facts. That collision is what we call a crash. Every bubble has two components: an underlying trend that prevails in reality and a misconception relating to that trend. When positive feedback develops between them, a boom-bust process begins. There was a real change happening in Europe. After decades of currency instability, European nations were moving toward monetary union. The Maastricht Treaty of 1992 set the path to a single currency. The ERM was designed as the mechanism to stabilize exchange rates in preparation. This was the truth at the core. European integration was real and gathering momentum. But this trend gave rise to a misconception that any exchange rate, once fixed politically, could be maintained regardless of economic fundamentals. That government commitment alone, backed by reserves and interest rate policy, could override market forces. This misconception was driving behavior that reinforced the trend, creating a self-fulfilling prophecy in the short term. Britain's entry into the ERM initially supported the pound, as markets assumed the government's commitment was credible, but this temporary success only deepened the ultimate problem. I've seen this before. In 1992, the British pound faced a similar situation to my earlier currency speculation. There was a real problem with Britain's position, but the misconception was that the Bank of England could defend the currency indefinitely against market forces. My funds made over $1 billion because we understood the reflexive process that governments failed to see. There's an ideology at work here, but not the one you might think. The British government was operating under a reverse form of market fundamentalism, the belief that political commitment could override market reality, that declaring something would make it so. Norman Lamont famously said in May 1992, the soft option, the devaluer's option, the inflationary option, would be a betrayal of our future. This was ideology masquerading as economic policy. The regulatory failure was systemic. Britain joined the at the wrong time during an economic boom that was already ending. At the wrong rate, 2.95 decimeters was too high, and for the wrong reasons, to import credibility rather than because fundamentals supported it. No stress testing, no consideration of what would happen if German and British economic cycles diverged. By August 1992, the Italian lira was already under pressure. On September 13th, it was devalued by 7%. Markets began asking, which currency is next? On September 15th, Bundesbank President Helmut Schlesinger told a journalist that further realignments might be needed. Though he later claimed this was off the record, the damage was done. The Bundesbank, Germany's independent central bank, had made clear it would prioritize German inflation over supporting weak currencies. This was the missing cavalry. Britain was alone. In every bubble, someone profits from the misconception. In the case of Black Wednesday, the beneficiaries were currency traders and hedge funds, myself included. My quantum fund had built a short position against sterling that eventually reached $10 billion. We borrowed pounds, sold them for Deutschmarks, and waited for the inevitable devaluation. Other hedge funds followed: Stanley Druckenmiller, Paul Tudor Jones, Julian Robertson. We weren't coordinating, we were all seeing the same unsustainable situation. The mathematics were straightforward. If the pound fell 15%, which seemed conservative, and we held a $10 billion position with leverage, the profit potential was over $1 billion. The risk that somehow Britain's $24 billion in reserves could outlast hundreds of billions in speculative flows, it couldn't. On the day itself, September 16, 1992, the Bank of England bought £2 billion worth of pounds per hour, trying to support the currency, but traders were selling £10 billion per hour. It was like trying to empty the ocean with a bucket. Some argue we speculators caused the crisis. This is wrong. We simply recognized reality before the government did. Britain's economy couldn't sustain 10% plus interest rates in a recession while maintaining an overvalued exchange rate. The crisis was inevitable. We just determined when it occurred. What concerns me most is not the economic damage, but what happens to democracy when governments pursue policies built on misconceptions and refuse to acknowledge reality. The Conservative government had staked its credibility on the When the policy failed as it had to, public trust in economic management collapsed. The Conservatives' poll lead went from 2.5% before Black Wednesday to minus 29% 1 month later. They wouldn't return to power for 18 years. This is dangerous for open society. When mainstream parties lose credibility through catastrophic policy failures, extremism gains ground. When people see billions spent futilely defending the indefensible, they lose faith in institutions. I survived Nazi occupation in Hungary. I've seen how economic crises destroy democratic norms and create conditions for authoritarians who promise simple solutions to complex problems. When £3.3 billion of public money vanishes in a single day defending a policy built on misconception, it creates exactly the kind of institutional failure that threatens democracy. Black Wednesday changed Britain's relationship with Europe permanently. It strengthened Euroscepticism, making future integration politically toxic. Brexit, in many ways, has its roots in September 1992, in the day Britain learned that European monetary cooperation could impose devastating costs on British workers and businesses. This is about more than money, it's about the survival of open society. To understand where we were in the boom-bust cycle on September 16, 1992, we need the macro context. The Federal Reserve had cut interest rates 8 times between 1989 and 1992. U.S. short-term rates were 3.4% in August 1992, their lowest in 30 years. Meanwhile, German rates were 9.9%, their highest in 60 years. This created massive flows from dollar assets into Deutsche Mark assets. But the ERM required other European currencies to maintain their value against the rising Deutsche Mark. It was an impossible situation. Central banks operate under their own misconception. They believe they can manage complex economic systems through simple tools like interest rates. They can influence trends, but cannot prevent reflexive processes from taking hold when fundamental imbalances exist. In the reflexive process, we typically see stages. Stage 1, the trend: Britain joins ERM, commits to currency stability. Stage 2, the misconception: government believes commitment can overcome fundamentals. Stage 3, the boom: initial success as markets give credibility a chance. Stage 4, the test: economic divergence with Germany creates pressure. Spring 1992. Stage 5, the climax: government doubles down, raising stakes higher. Stage 6, the reversal: reality asserts itself, trend collapses. On September 16, 1992, we were at Stage 6. The Italian lira had already been devalued. Schlesinger had signaled no German support. The UK economy couldn't sustain higher rates. The only question was timing. Let me show you what this meant financially for ordinary Britons. Before ERM 1988, average mortgage rate 9.5%. Unemployment 6.3%. During ERM 1992, average mortgage rate 12.15, unemployment 9.9%. After ERM exit 1997, average mortgage rate 7.5%, unemployment 5.5%. For a family with a £100,000 mortgage, the difference between 15% and 7.5% rates is £7,500 per year, more than £600 per month. Over the 2 years Britain was in the ERM, this policy cost families approximately £15,000 in extra mortgage payments, while home values fell and job security evaporated. The total economic cost was far higher: £3.3 billion in direct government losses, billions more in destroyed businesses, lost jobs, foreclosed homes. The human cost of defending an indefensible misconception. This wasn't just a British crisis. Black Wednesday revealed fundamental problems with fixed exchange rate systems in a world of free capital flows. The day after Britain withdrew, Italy also suspended ERM membership. Over the next year, Spain and Portugal devalued. In August 1993, the ERM bands were widened from 2.25% to 15%, essentially making the system meaningless. Currency crises are contagious. I learned this investing in currencies throughout my career. The mechanism is simple. When one pegged currency breaks, markets immediately test others. If Britain couldn't defend with $24 billion in reserves, could France defend with its reserves? Could Spain? France managed to stay in the ERM, but only by spending $35 billion, 50% more than Britain spent. The Banque de France actually made a profit eventually, buying cheap francs during the crisis and selling them later when stability returned. But France wanted to be in the euro. Britain didn't, which made all the difference. In political will, the interconnectedness created systemic risk. European monetary integration nearly collapsed. Had France also been forced out, the entire path to the euro might have been derailed. Instead, Black Wednesday became the crisis that proved which countries were truly committed to monetary union and which weren't. Let me tell you what you need to do both to protect your finances and help preserve open society when you recognize similar patterns forming. First, embrace fallibility. Recognize your understanding of any economic situation is imperfect. Mine is too. This recognition is wisdom, not weakness. The British government's fatal error was refusing to admit their ERM policy had been a mistake. If they had acknowledged reality in early 1992 that the exchange rate was unsustainable, they could have negotiated an orderly realignment. Instead, they defended the indefensible until market forces destroyed them. Be flexible, adjust as new information emerges. As I say, I'm not better than the next trader, just quicker at admitting mistakes and moving on. Second, understand reflexivity in your decisions. Your actions are part of the system. Ask yourself, am I following a trend because it makes sense or because others are? How might my misconceptions be shaping my decisions? What feedback loops am I participating in? In 1992, everyone knew Britain was committed to the ERM. Everyone knew governments could defend currencies. These shared beliefs created the bubble. When reality intervened, those who had questioned the consensus prospered. Third, protect yourself strategically. Based on the pattern of Black Wednesday, here's how to position yourself when you see similar situations. If you're highly exposed to a policy built on misconceptions, reduce exposure immediately. Regardless of political commitments, don't assume government promises can override economic reality. Calculate what would happen if the policy collapses, because it probably will. If you're moderately positioned, look for assets that benefit from policy reversal. In 1992, that meant selling sterling and buying Deutsche Marks more broadly. It means hedging against unsustainable commitments. If you're insulated but see the pattern forming, consider how to position for the inevitable adjustment. The post-crisis period often offers opportunities as policy normalizes. British assets actually performed well after ERM exit. Key principle: don't try to time the exact moment of collapse. When I see an unsustainable situation, a bubble built on misconception, I position for the inevitable outcome. I don't predict September 16th versus September 20th. I recognize that a government spending billions per day to defend an overvalued currency in a recession will eventually fail. Look for these indicators. Growing divergence between policy and economic fundamentals. Government rhetoric becoming more committed as situation deteriorates. Other market participants beginning to test the commitment. Reserve levels falling while pressure increases. Fourth, engage politically. This is a policy problem requiring political engagement. After Black Wednesday, Britain adopted inflation targeting, giving the Bank of England independence in 1997. This framework served the country well for decades. It replaced misconception with a clear, measurable policy goal. Support candidates who acknowledge when policies aren't working, base decisions on evidence rather than ideology. Understand systemic risk and market dynamics. Value institutional credibility over short-term political prestige. Oppose market fundamentalism, the belief that markets are always right, but also oppose its inverse, the belief that political will can override market reality indefinitely. Fifth, think systemically. Don't just protect your interests. Support policies that allow exchange rates to adjust to economic fundamentals. Give central banks independence from political pressure. Build adequate reserves before committing to fixed systems. Acknowledge failure quickly rather than defending the indefensible. The survival of open society depends on citizens who think beyond immediate self-interest and recognize when policies serve ideology rather than reality. Let me conclude with the two ideas that have guided my life: fallibility and reflexivity. We cannot know reality perfectly. Our understanding is always imperfect, distorted by biases and limitations. The British government in 1992 couldn't see that their policy was destroying their economy because admitting it would mean acknowledging a catastrophic mistake. In financial markets, this creates opportunities but also catastrophic risks when misconceptions guide policy. And our perceptions don't just reflect reality, they help create it. The feedback loop between thinking and reality drives boom-bust cycles. Britain's commitment to defend the pound actually made its collapse more certain and more damaging, because it increased the size of the eventual adjustment. Black Wednesday was following a pattern I've observed throughout my career. The trend defending an overvalued currency through political will was built on a misconception that commitment could overcome economics. The misconception reinforced the trend temporarily as markets gave Britain the benefit of doubt. Eventually, reality asserted itself, and the adjustment was catastrophic because the government had made the stakes so high. But we have agency. We can recognize misconceptions. We can interrupt feedback loops. We can prevent catastrophic outcomes. This requires intellectual honesty, admitting when we're wrong. It requires political courage, changing course when evidence demands it. It requires systemic thinking, understanding how our actions shape the reality we inhabit. The conceptual framework of fallibility and reflexivity helped me make billions not by being smarter than others, but by being more willing to acknowledge when conventional wisdom was built on misconception. More importantly, it's helped me understand the forces shaping our world. I hope this framework helps you understand not just Black Wednesday, but the boom-bust patterns that will inevitably occur again. Markets are always wrong. The question is by how much, and whether we recognize the divergence before reality forces recognition upon us. The British government learned this lesson at a cost of £3.3 billion and nearly 2 decades out of power. You don't have to learn it the same way. The future is uncertain, but we can shape it if we understand the reflexive process we are part of, acknowledge our fallibility, and have the courage to act on reality rather than misconception. Thank you for watching.